the yield curve starts to uninvert. That yield curve uninverting is when gold starts to outperform. Right now, we're entering that bull market in gold. The next phase, in my opinion, is a weakening of the dollar. So we're going to start to see the rates come down. And what I would be looking at is your dollar to see if the dollar starts to weaken. If the dollar starts to weaken and we get weaker and weaker dollar, that is the denominator of our commodities being priced with something that's losing its value against other currencies. And we're also going to see money flows shift in the market differently. We've got a bull steepener, which means the long end of the curve has been going up.
As the yield curve begins to uninvert, gold tends to outperform, signaling the start of a bull market in gold. They anticipate the next phase to be a weakening US dollar, which would lower interest rates. A weaker dollar, being the denominator for commodities, will push their prices higher. This shift could also alter money flows in the market, with recent trends showing an increase in the long end of the yield curve. Andy Hoese is a notable figure in the investment and finance world, recognized for his insights into commodity markets, particularly in metals, energy, and macroeconomic trends. He suggests that we are entering a period where gold will outperform other assets, driven by an inverted yield curve. As inflation slows and the yield curve normalizes, gold acts as a safe haven. This phase is marked by gold's outperformance, signaling we're near the end of the business cycle. Silver is expected to follow, as it typically outperforms in the later stages of the cycle. The speaker Andy Hoese explains that when investors put money into a strong U.S. stock market and a strong dollar, they benefit from both market appreciation and currency exchange gains. However, if U.S. equities underperform and the dollar weakens, money will rotate into other markets. The speaker predicts this shift will mark the next phase of the commodity bull market. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
The era is measured by gold against other assets like gold to S&P 500. So I think we're entering that era right now. When the yield curve inverts, so when we get these pulses of inflation, those pulses of inflation are generally driven by the real estate cycle and the demographic coming through home buying years, and then they create credit in the system. That's looking backwards historically. Impulses could also be created by stimulus and or fiscal spending. So when we get these impulses of inflation into the system, it inverts the yield curve. Commodities also expand because the credit being created in the system puts everything into a shortage. So oil being the closest or number one commodity to that inflation is the one that benefits the most. That's why it's a very inflation sensitive asset. It's the number one commodity. So you get an impulse of stimulus, credit, whatever it is, and then you start to see things react because oil and these commodities cannot react fast enough to the credit creation. So it puts everything into a shortage, so to speak. And then you get inflation. Inflation is a shortage of those commodities. Essentially, it's too much money chasing too few of goods. And then it pulls everything in the system into the manufacturers and stuff like that to produce. So that impulse move that we got in 2020 came up and then it started slowing down. They raised rates, they started slowing that credit expansion, and then they slowed on down. And that's towards the end of the cycle where we're at today, where the yield curve starts to uninvert. That yield curve uninverting is when gold starts to outperform. Gold is, quote, the safe haven asset. So that's where it earned its name, safe haven, because when the yield curve uninverts and that impulse of inflation starts to slow down, the yield curve starts to normalize, that is the slowdown and, quote, the safe haven aspect of gold, and that's when it outperforms. And that's exactly where we're located right now, is that impulse of the inflation is slowing down, the yield curve starting to uninvert, and gold is outperforming. It is a marker of where we're at in the business cycle. Gold leads, and what comes next is generally the bottom of some cycle will come. We'll see silver outperform on the back half of this cycle, and it generally outperforms when they do stimulus or credit creation, or we start to see that stuff come into play. So we'll see silver start to outperform at some point, because what it's doing is it's front running that stimulus, the lowering of rates, all that stuff. So I think gold's our leader, which is going. Silver's going to hit next. People, when they invest, overseas and here, they want to see a strong stock market and a strong currency. So they're playing it twofold. They're playing the price appreciation of the market, and they're playing price appreciation of the currency. So if you have a strong United States stock market and a strong dollar simultaneously, and you're living in another country that is a non-dollar denominated currency, you can put your money in that market and earn currency exchange differences and returns on the US equities. I think the emerging markets areas, I think, are really good spots to look at. I think you're going to see potentially outperformance of commodity currencies here. This is the beginning of that next leg of the commodity bull market. It's very similar to 2001, 2002. We went through that tech cycle in 2000, 2001. We had the slowdown. They lowered back interest rates. The dollar started to fall against the Canadian dollar, against Brazilian real and other currencies.
The speaker, Andy Hoese, believes that platinum is currently the cheapest metal compared to silver, gold, and palladium. Recent news about platinum highlights an expected market deficit in 2024, driven by strong demand across sectors such as automotive, industrial, and jewelry. The deficit could surpass 1 million ounces according to forecasts, making it the largest shortfall in over a decade. They expect platinum to come into favor when the US dollar weakens, likely within the next 6 to 12 months. Platinum, being highly sensitive to inflation, is expected to outperform gold and silver in the next cycle. The speaker Andy Hoese highlights that while gold is performing well, silver is likely the most asymmetric opportunity in the short term. In the long term, they see natural gas or oil as the most asymmetric investments. Currently, crude oil is lagging behind gold, with the gold-to-oil ratio at about 37 to 38, meaning 1 ounce of gold can buy around 37 barrels of oil, which is historically low, and suggests oil is undervalued relative to gold. Andy suggests that when the yield curve flips, unemployment typically rises. This signals the start of a money rotation, potentially shifting from tech stocks to commodities. While precise timing is uncertain, there is an expectation of an impending slowdown in the tech sector, which may lead to a shift toward commodities that could outperform in the market. Let's dive into the interview.
A lot of people are getting frustrated with it. But when the dollar drops here, and I think it will occur, I don't know when it will exactly occur, but I think it'll occur over the next 6 to 12 months. Platinum is the cheapest of the metals in a ratio perspective against silver, gold, and palladium, and even rhodium. It is cheap against. Whenever you get that type of alignment, you get, and it's got huge asymmetry too. Asymmetry, big upside, small downside risk here. It's got all of what I consider the alignment that I look for of everything. Cheapness, the market, the technicals look very good, and the cycle's coming, it's bottomed right now, and it's going to start to come into favor soon. I think it will come into favor when that dollar drops. It's very highly correlated to inflation. It's the most inflation sensitive metal. Of the other, versus gold and silver. So gold is the safe haven. Silver is kind of close to it. And then platinum comes behind it. Platinum's more correlated with oil than it is with some of the, it's got a cross between gold and silver and a cross between oil, because there is some inflation sensitivity there. So I think that will come next. And when we start to see platinum start to outperform, it is telling you about the market condition we are in if it starts to outperform silver and gold. Gold is the safe haven. And when we transfer into this next cycle, we can use the ratios to say, yep, this is starting to outperform. We're getting more into an inflationary part of it. And we can also use oil too. And that'll be next, in my opinion. So I think platinum's fine. It's just we haven't gotten into its full-on cycle yet of alignment. I think gold is really good, and I think silver is going to be your most asymmetric in the short term. Longer term, if you take everything away and strip it, I think the most asymmetric play overall is probably natural gas or oil. And right now, they are really, really low in relationship to gold. Gold's the leader, so gold's ripping. Go, 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 go. And then we've got behind it the lagging crude oil at $70. So our ratio is up around I haven't looked recent, but it's around 37, 38. So 1 ounce of gold can buy 37, 38 barrels of oil. That is incredibly cheap compared to history. Usually what we see is when the yield curve uninverts, unemployment goes up, we see the tech sector usually, somewhere in the stock market fall because we go through a slowdown. When that occurs, that's the beginning of a rotation of money, right, is usually when these things start to rotate a little bit different. We could be at the beginning of a rotation eventually here, where tech stocks start to slow down. Maybe we have a blow off top left in it. And then we rotate eventually into commodities, and that ratio starts to move. The tough part is when exactly will that occur? It's hard to know. I would have guessed, we would get a slowdown here any second, and that we see technology kind of slow down, and it could grind sideways, it could pull back, it could go down a lot depending on what occurs in the commodity markets.
A significant shift in financial markets driven by the yield curve reversal causes a weakening US dollar and rising inflation. This environment is expected to benefit gold and other commodities, with silver, platinum, and oil offering strong asymmetric opportunities. As the tech sector slows, money may rotate into commodities, marking the next phase of a bull market in this space. How might a weakening US dollar impact global commodity markets? Share your thoughts in the comments below. We'd love to hear from you. If you found this video useful, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.